So come to IAS 32 again. We have discussed how to identify a liability. Contractual right to deliver cash or another financial asset or exchange financial asset or financial liability under conditions which are potentially unfavorable. In case of equity, there is no contractual obligation to deliver cash or another financial asset. The discretion is with the entity to deliver cash or not. Again, there is a note written below. There is an exception to this rule for certain putable instrument and the instrument with an obligation to deliver a pro rata share of the net asset only at the time of liquidation. Now look at this flow chart drawn in your book also. If you have to check whether the instrument is debt or equity, then we will see whether there is an obligation to deliver cash or another financial asset to another entity. If your answer is no, then this instrument will be equity. If the answer is suppose or if this is not there, then check whether there is an contract to exchange financial asset or financial liability with the holder under conditions which are potentially unfavorable to the issue. Again, if the answer is no, it is an equity. Or check to redeem the holder at a fixed or determinable future date. If the answer is no, equity. If the answer becomes yes, it is a debt instrument. So either there must be an obligation to deliver cash or unfavorable condition, or you have the obligation to redeem at a future date. The instrument becomes a debt instrument. Now we'll solve few questions for clarity. All these questions are potential question for exam purpose now. So solve this question number 4, I think in your notes. Alpha Limited issued an option to buy or sell fixed number of share at a specified exercise price. Read the full question to come to a conclusion. Don't be in a hurry. The terms of the option state that the specified exercise price varies with the share price of the Alpha Limited. Exercise price will vary with the share price of Alpha Limited. So there is a hint in this line. Share price, if it is 10 rupees, the conversion ratio will be 10 share at rupees 1 per share. But if the market price of this share is 20 rupees, the conversion ratio will be 10 share at rupees 1.50 per share. Is the option a financial liability or equity? Check fixed for fixed test. Are we having a situation where we are going to receive a fixed amount for a fixed number of share, or there is a possibility that the amount of cash received can vary depending upon the market price? So what do you think? Possibility of variation is there. Possibility of variation is there. If the market price is 10 rupees, you will get 1 rupee per share. But if the market price is 20, you will get 1.50. Okay. So is the option a liability or equity? I have given the answer, but not very explicitly. Implicitly I have given liability, because the amount of cash that you may receive is variable. So if the answer is not written, write down. The variability in the exercise price. The variability in the exercise price as a function of share price of Alpha Limited. As a function of share price of Alpha Limited. results in a variable amount of cash for a fixed number of shares and hence fixed requirement is not considered. Full stop. Next line. The option is therefore treated as a derivative financial liability. The option is treated as a derivative financial liability and not an equity instrument. This much you have to write for, say, 4 marks question or 6 mark question. Okay, try one more. We are also learning the writing skill of the answer. Only yes, no, don't know is not enough. Are deferred revenue and warranty obligations financial liabilities? Deferred revenue means suppose you have received a grant from the government and which you have transferred to deferred revenue account, and then you will transfer it to statement of profit and loss over the number of years. So that is deferred revenue. And warranty obligation means you are selling some product, giving a warranty to the customer. In case of any defect, we will rectify. So you have an obligation. In case of government grant, if you don't fulfill the obligation, normally you have to refund. But otherwise you will recognize in the statement of profit and loss. And in warranty obligation, you have to render service or give the goods, replace the goods or repair the defect. So are these financial liability? Yes, vote for yes. Vote for no. 100% vote. Okay. So these are not financial liabilities, but then you have to answer why. There is no contractual obligation to pay cash or another financial asset. There is no exchange of one financial asset against another financial asset for conditions which are unfavorable. Is it right? So nothing like that. So write down the answer. Items such as deferred revenue, you write in one sentence only. Items such as deferred revenue and warranty obligations, write one continuous sentence. Items such as deferred revenue and warranty obligations require delivery of goods or service. You have to write this. If it is a 2, 3, 4, 5 mark question, okay. Require delivery of goods or service rather than, now we are answering why it is not a financial liability. Rather than an obligation to deliver, cash or another financial asset. Comma, and again comma, therefore, again comma, are not financial liabilities. Okay, try this next one, easier one, 6 number question. Those who have written. Are obligations to pay tax, company registration fees, and other similar charges financial liabilities? You may have to pay cash here, but then there is no contractual obligation, statutory obligation. So statutory obligations are not covered by this standard. Write the answer. Obligations to pay tax, company registration fees, and other similar charges are obligations to pay cash. However, justification is required for anything more than 1 mark question. Okay. However, these are statutory rather than contractual requirement. And therefore they are not financial liabilities. Right? Okay, this question is over. First we will discuss now characteristics of liability, and again some question we will discuss. Just write one more note if you want to add one more line. Similarly, constructive obligations. This is just extra information. Similarly, constructive obligation, in bracket write as defined in IAS 37 or Ind AS 37, do not arise from contracts and are not financial liabilities. Now, what is a constructive obligation? An obligation arising due to your business practice, past business practice, like the policy of giving refund if the customer is not satisfied. But that is not a contractual obligation. It is just because you want to maintain good relationship with the customer, you refund. So at the end of the year, you may make a provision for refund. So that's a liability, but that is not a financial liability. So that will be accounted under IAS 37 or Ind AS 37, not under this standard. Next paragraph is characteristics of liability. Mandatory redemption and or mandatory interest payment. So the moment you find there is a mandatory redemption liability or a mandatory interest payment, which means entity has no discretion whether to pay or not, then this will become a liability. When an instrument requires mandatory redemption by issuer for a fixed or determinable amount, now underline the word determinable, fixed or determinable. Determinable can be, say for example, fixed amount plus some percentage like premium on redemption. A contractual obligation to deliver cash or redemption exists and therefore the instrument is a liability. Now again there are two exceptions here: putable instrument and instrument that contain an obligation to deliver a pro rata share of net asset at the time of liquidation. Because even though they do meet the requirement of payment of cash, the standard has given them exemption from classification as liability. Okay, so now think and answer. Are mandatorily redeemable preference shares financial liabilities? An entity A has issued preference share that are mandatorily redeemable at par in 10 years. Is it a financial liability or equity? What you have learnt in your foundation course? Is it a part of share capital or non-current liability? Share capital. Now in final your view have changed. Go and ask for refund from your teacher. Now, so the answer is it is a liability now, although you have been showing it in the shareholder fund or equity share capital, preference share capital, reserve and surplus for so many years. But now, if it is an Ind AS company or a company following IFRS, then this will come as a liability, financial liability. So the answer is a contractual obligation to deliver cash exists. Lot of ratios will change now because of this preference share classification. Earlier it was part of equity, so a debt equity ratio used to be good, but now it will be part of liability, so a debt equity ratio will become bad now. Contractual obligation to deliver cash exists for the repayment of principal. The issuer cannot avoid the outflow of cash in year 10. Therefore, preference shares should be classified as a financial liability. Therefore, preference shares should be classified as a financial liability. Next question is, are perpetual instrument financial liabilities? Are perpetual instrument. What is perpetual instrument? The redemption date is indefinite. The redemption date is indefinite. That means they have not defined when will the redemption take place. Okay. So companies do issue perpetual debenture, perpetual bonds. Maybe in India legally right now you can't issue perpetual preference shares, but other instrument you can issue perpetual, but you have to pay interest on them. Or in case of perpetual preference share, you will have to pay preference dividend on them periodically, half yearly or yearly, annually. So are these instrument liability or equity? Perpetual instrument provide the holder with no right to require redemption. However, the terms of such instrument often require the issuer to make coupon payments into perpetuity. Okay. So the answer would be, it will be a liability because there is an obligation to pay interest. Now, of course, it depends on the redemption coupon payment. Is it mandatory or is it at the discretion? We will assume mandatory interest and mandatory dividend payment. Otherwise, it is difficult to find investor for such instrument. Will you invest if I issue a 10%, 20% interest perpetual debt, but interest will be paid at my discretion? How many of you will invest? 20% I am offering you. State Bank gives only 6, 7, 8%. None of you are investing because I have kept the discretion, right? So therefore, normally the interest and dividend would be mandatory. Otherwise, who will invest in such instrument? Rarely. So write down the answer. This line you write down, third line. First two lines are printed. A perpetual instrument with a mandatory coupon. Mandatory underline because the answer will change if it is discretionary. Is a liability in its entirety because the whole of its value is derived from the stream of future coupon payment, is derived from the stream of its future coupon payment. So normally in such instrument, what happens? The amount that you pay for the instrument is nothing but the present value of all future coupon. For example, only for understanding, A company will pay you 10,000 rupees coupon every year and your required rate of return is 10%. So the formula to calculate the present value of a perpetual debt instrument is your cash flow, annual cash flow divided by your required rate of return. So in this case the answer will be 1 lakh. So you are going to pay 1 lakh rupees. You are going to get 10,000 rupees every year forever. So what you are getting is nothing but the present value of all the future coupon. This is what you have paid for. So this will become a financial liability in its entirety. Are perpetual coupon bearing preference share financial liability? Same question. First you write this example, which is printed there. A perpetual instrument is issued at par amounting to rupees 100 million requiring coupon payment of 8% to be made annually. Provided that 8% is the market rate of interest. Because if 8% is the market rate of interest, the present value will also come to 100 million. But if the market rate of interest is different, the present value will be higher or lower than 100 million. So in the exam, what you will do, you will write this note that it is assumed that the market rate of interest is also 8%. Hence, the entire instrument will be treated as a financial liability. Provided that 8% is the market rate of interest for this type of instrument, when issued, the issuer has assumed a contractual obligation to make a future stream of 8% interest payment. The net present value of interest payment will be 800 million and represent the fair value of the instrument. What was the question? Is this instrument a liability or equity? Liability, because the present value of this bond is exactly, or this preference share is exactly equal to its present value of future coupon. So what are the 2 points you have to mention in your answer? First, we are assuming that it is a mandatory coupon payment. Second, we are assuming the market rate of interest and the coupon rate both are equal. Okay. Market rate of interest means the discount rate that you use. Coupon rate is what is contractually the company is going to pay it to you. Are mandatory distribution of a percentage of profit of an entity financial liability? Vote for yes. Mandatory distribution of a percentage of the profit of a company. Is it a financial liability? Company says to the investor of whatever instrument, will pay you 10% of the profit. If the company makes profit, you have to pay 10%. If company does not make profit, it won't pay you the whatever interest, dividend, profit share. Yes? Yes? No? Okay. So it is just a different way of paying the interest. Instead of paying a fixed interest, we are paying a variable amount of interest, but it is mandatory. Can we avoid making the payment of this amount? Yes, we should continuously make losses. Okay. Of course, you will not do that. You are a businessman. Okay. Just to avoid interest payment, you can't suffer the losses. So the moment you have profit, you have an obligation to pay profit share to the investor in cash. So this time it is a variable amount you are going to pay, but it is mandatory. I never said that you have to pay a fixed amount every time. There must be an obligation to pay cash or another financial asset. Okay. which the company cannot avoid. So such an instrument meets the definition of liability. Or you want to write this line also? Right. Some instruments may require a mandatory distribution of a percentage of the profit. Mandatory distribution of a percentage of profit of an entity. Write little fast. To the extent that such profits are generated rather than of a traditional interest payment. How many if you're thinking mentally the answer is no? Honestly answer. Wow. There are some students. Such an instrument meets the definition of financial liability. Such an instrument meets the definition of financial liability because it is a contractual obligation. It's a contractual obligation of the issuer to deliver cash or another financial assets to the holder. Okay. Then, okay, one question with answer is appearing now. Just one more line to complete this answer. The issuer has no discretion over paying out a percentage of its profit. The issuer has no discretion over paying out a percentage of its profits. This way you have to write the answer. You don't have to write 2 pages for getting 5 marks. One question is printed, I think, in your notes. Just see. No, it's not printed. You want to write or you just want to discuss? Okay, discuss. X Limited issues perpetual debenture of the face value of rupees 10,000. Debentures do not carry any fixed interest. As per the attached condition, the board of directors would decide the rate of interest based on the profit earned by the company in the financial year, and that the board may pay arrear of interest if any. Should the perpetual debenture be classified as equity, how it will be accounted for? So is it equity or liability? Read again. Read the red font. I have given you the hint. Is it a liability? Can the company avoid paying interest? It's a perpetual interest, so only interest will be paid. Interest would be paid at the rate decided on the basis of profit. Board will say we'll pay 0% interest. So in the beginning I said there is a lot of judgment sometime involved for an instrument like this. Okay. So the answer for this question was equity instrument, because the board has now a discretion. There is no mandatory principal payment. There is no repayment of principal. So the test of no obligation to deliver cash or other financial asset is satisfied. Debentures are classified as equity instrument and measured at issue price. If any interest will be paid at the discretion of the board, it will be paid, suppose, it will be treated as dividend rather than interest. So it will not be shown in the statement of profit and loss. It will be directly deducted from retained earning in the statement of changes in equity. Is it right? You want to write or you have understood? Understood? Good. This question is there. Answer is also there. Relax. X Limited issued 1,12% perpetual debenture of rupees 100 each on 1/4/2014. Classify this perpetual debenture as financial liability or equity, explaining accounting treatment, assuming that this line is not there in the question, right? Assuming that market rate of interest at the time of issue is 11.5%. Now that will change your answer. Had this not been given, this line, the answer would be the entire instrument will be treated as a financial liability. But now there is a problem. The coupon rate is 12%, but the market rate is 11.5%. So first we have to find out the fair value of this instrument. How will you find the fair value of this instrument? Apply that mathematical formula, annual cash flow upon required rate of return. Annual cash flow will be 12% of 1 lakh, 12,000. Required rate of return will take market rate, divide by 11.5%. So how much it comes to? Into 100 also, because the face value is 100. See, how will you do the calculation? First in the exam you will write calculation of fair value of the liability. It is a liability because there is a mandatory 12% coupon. 12% of 1 lakh number 100 face value, divide by market rate. So tell me the value of this calculation. Is it 104,34783? That is a fair value. And how much is the issue price? Issue price will be 1 lakh into 100. So there is a gap between these two numbers now. This is 1 crore. And the fair value is this much. So what you will do? The remaining amount you will treat it as loss and you will capitalize it at 1 crore 4 lakh. What is that? 34,783. Is it right? So write down the journal entry. It's written. Wow. Bank account debit 1 crore. Fair value loss account. This difference. To perpetual debenture account 1 crore 4 lakh 34,783. And every year now what you will do? You are going to pay an interest amount 12 lakh to bank account 12 lakh, and that 12 lakh every year will continue. Now next is contingent settlement provision. What is the meaning of contingent settlement provision? That means here the cash flow or the payment will be made subject to some future event. Okay. For example, A Limited issues bond to B Limited, says we will pay you interest only if GST is abolished. That is a contingent settlement provision. Whether this instrument is a financial liability, there is nothing to laugh. This is the question. We will pay you interest at when Rahul Gandhi becomes Prime Minister. Financial liability or equity? Equity. Something like this. Okay. When a particular thing will happen, we will pay you the interest principal. So that is contingent settlement provision. Now whether in that case it is a liability or equity, you have to check the 3 conditions mentioned here. So listen to me carefully because you have to solve few questions below that. Financial instrument may be structured such that the obligation to deliver cash or another financial asset arises only on the occurrence or non-occurrence of uncertain future event that are beyond the control of both the issuer and the holder of the instrument. But if this event happen, then the issuer does not have an unconditional right to avoid the obligation to deliver cash or another financial instrument, and therefore such instrument will be classified as financial liability. But again, what you have to see, what is that kind of contingent settlement provision? Unless the contingent settlement provision that could require payment in cash or another financial asset is not genuine. Subjectivity is getting involved here. That means you have to see whether this settlement provision is genuine or not. That is, whether it seems real, possible or not. Okay. If you have a doubt that this is not genuine, this is just designed in such a manner for a particular type of financial position, then it is not a financial liability. Is it right? So, like first example I gave, we will pay you interest when GST will be abolished. Not genuine. Is it right? How will the government run without tax? That's not going to happen. So it's not a genuine transaction. Equity, because this event is not going to take place. At least this is what we believe. Second example, when Rahul Gandhi becomes prime minister. So how many of you think it is now equity or liability? Race for equity. Oh, 50%. All BJP people. Now many of you think it is a financial liability? Mamata Banerjee people. Now come to next point. Settlement in cash or another financial asset can only be required in the event of liquidation of the issuer. Okay. Or the instrument meet the specified criteria for a putable instrument or an obligation arising on liquidation to be classified as equity. So if these conditions are satisfied, welcome. It is a financial liability, otherwise equity. Putable instrument which requires you to pay pro rata payment on liquidation, as we have discussed continuously, will be equity. Okay. So what do you mean by genuine? Genuine means not counterfeit. That is a provision that is authentic and has commercial substance. A provision that is extremely rare, highly abnormal, and very unlikely to occur is not considered a genuine transaction, and therefore it will be equity. Some example of future conditions that can be incorporated in your contract. A change in macroeconomic, industry and other indices such as stock market index. So this you can put in your condition. If BSE Sensex exceeds 39,000 points, we'll pay you 10% interest. Seems to be genuine. Consumer price index, growth in GDP or industrial production, change in law. But change in law, again you have to see the authenticity. Okay. Government regulation, other regulatory requirements such as change in tax, price control, accounting, and changes in key performance indicator like EPS, market price, debt equity, etc. Now I'm going to give you some interesting case studies. Think for 30 seconds and tell me, is this a case fit for financial liability or not? 30 seconds starts now. Potential question for 5 marks. Is the answer written there? No. Good. so that you are thinking. So how many of you think that it is a financial liability? Okay, three options are there in this question: financial liability, equity, compound instrument. Compound instrument means some portion of it is liability and some portion of it is equity. So there are two parts in this. One is your dividend and one is redemption. So first talk about dividend. Look at dividend, first line only at the top. Is dividend discretionary? Dividend is equity. Now talk about redemption value. Is it a liability? Liability is redemption will take place when tax or accounting law will change. Question has said it is a genuine contingent settlement provision. So this portion will become liability because this tax or accounting requirement can change, and the moment they change, you have no option but to make the redemption. Is it right? So this instrument is actually a compound instrument because it has both features of equity and debt. So write this small answer. Little fast because after that I am going to take many numerical questions. As the contingent event is genuine. Now it is mentioned in the problem. In the exam, if nothing is mentioned, you assume genuine if you think it looks genuine. And can result in the issuer having to deliver cash or another financial asset at a time, write in good handwriting. 2 persons should be able to read, you and the institute. At a time other than the entity A's liquidation. This is an exception. If it is payable at the time of liquidation, then it is an equity. The instrument is classified as a financial liability. So for this portion, redemption portion, it is a financial liability. However, the 5% dividend is at the discretion of entity A. So this portion is equity. 5% dividend is at the discretion of entity A and consequently is equity of entity A. And this is your concluding line. Therefore, the preference share contain both debt and equity features. Preference share contain both debt and equity features. That is, it is a compound instrument. About compound instrument will come in the next page in detail. For the time being, it means an instrument which has both debt and equity features. But next 10-15 pages are compound instrument only. Yes. Now one more question try. Is the answer printed here? No. Then you will try. 30 seconds. Start 30 seconds. Check whether you are exam ready or not. Question is, entity B issues shares of currency unit 1 million. Dividends are discretionary. Entity B must redeem the share for par. So dividend is discretionary. That portion is equity. What about redemption? Entity B must redeem the shares for par in the event of a flotation or IPO of the entity. Entity B cannot guarantee a successful flotation or IPO, but it does have discretion as to whether or not to instigate proceedings to float or to seek an IPO. Is the instrument a financial liability? So, three options. You tell me, how many of you think fully financial liability? No one. Fully equity. Fully equity. 100%. Compound instrument. Compound instrument. 100% vote has gone for equity. So the answer is right, because both are at the discretion of the entity. They will not come out with an IPO only forever, and therefore they are not required to redeem the face value also. Okay. So this way you can avoid the principal payment till you come out with the IPO, and IPO or flotation of share is purely at the discretion of the entity. So the answer is given that entity B can avoid redeeming the shares, by avoiding the flotation or IPO. The instrument is classified as equity. The instrument is classified as equity. Okay, now I'm going to test what the answer is printed for next question. Close the book first. Close the book first. Then come to the screen. I hope you have honestly closed the book. Read the question on the screen and tell me whether this instrument is a financial liability or not. This time you don't have to write the answer. Only thinking is required. Financial liability? Vote for financial liability. Little on a higher side, I can't see. Vote for equity. Equity. Compound instrument. Compound instrument? Why do you think it is compound instrument? This question has not given any information about dividend or interest payment. So ignore that. Only redemption is discussed here. Dividend was in the previous problem. This one. Dividends are discretionary. This question does not have any dividend discussion. Only redemption. Redemption is at the discretion of the company. True or false? False. Because although you can't guarantee successful flotation, but you can't stop 5 years from passing. Time will pass. Okay. And after 5 years, you have no option but to bring an IPO. And if you bring an IPO, the redemption will get triggered and you will have to pay the amount. So you don't have the discretion to avoid the payment. You can only delay it up to 5 years. Okay. So the answer is, I think the answer is printed in your notes. We'll just read from there. Given that the contingent event, successful flotation or IPO, is not in the control of entity, say, it is a contingent settlement provision. Contingent settlement provision is considered genuine. It is potentially payable other than at the time of liquidation. It is not a putable instrument. Because entity C cannot avoid redeeming the share for cash, the instrument contains an obligation to pay cash that creates a financial liability. So we have discussed financial asset, financial liability. Now some discussion on equity and then few questions on that also. Equity instrument. A financial instrument is classified as equity instrument only if the instrument fails the definition of a financial liability. So what we have to see whether it is an equity or not, whether the issuing company, the entity has an unconditional ability to avoid delivery of cash or another financial asset. If you can avoid delivery of cash or another financial asset unconditionally, then the instrument will become a equity instrument. In the previous example, we didn't have this unconditional power. But before that, the question that we had solved, we had that unconditional power to avoid the IPO forever. And therefore, that instrument had become equity to that extent. This ability is not affected by, even if the company is making regular distribution of dividend. Even in the last 40 years, you have paid dividend. Still, the instrument can be equity if the dividend is at the discretion of the entity, because next year you can avoid it. Or intention to make distribution in future, or a possible negative impact on the price of the ordinary shares of the issuer if the distributions are not made on the instrument concerned. It does not depend whether you have enough reserve in the company or not. It does not depend on issuer's expectation of profit or loss, or the ability or inability of the issuer to influence the amount of its profit or loss for the period. All these are not relevant. What is relevant? Unconditional ability to avoid delivery of cash or another financial instrument. Now, provided that dividends are at the discretion of the issuer, it is irrelevant whether dividends are cumulative or non-cumulative. Because to confuse you, the institute may give you the dividend is cumulative. But if it is discretionary, let it accumulate. Don't pay only. It is equity. Is it right? Suppose your stipend is discretionary at the hand of your boss, he will not pay. Let it accumulate. After 3 years also he will not pay. But one example on dividend. Once the dividend is declared properly by following the due process of law, and the moment it is declared, it becomes a liability. Then you have to show it as a liability. So once a dividend is properly declared, depends on interim or final dividend, then it gives rise to a legal requirement to pay. A contractual obligation to deliver cash comes into existence, and a financial liability for the amount of declared dividend should be recognized. Similarly, a liability arises upon liquidation to distribute to shareholder the residual asset in the issuer. The existence of an option whereby the issuer can redeem equity share for cash does not trigger the liability, because the issuer retains an unconditional right to avoid delivering cash or another financial asset. For example, there may be suppose a convertible bond, but conversion is at the option of the entity. So what the entity will do? It will not pay cash. Then in that case, even though the option to pay cash is there, either cash or share, but you can avoid paying cash. So remember this line, because I am going to solve a question on this. If the issuing company has an option to take decision on conversion, then it is equity. But if the holder of the instrument has an option, now whether he wants cash or equity, that we'll see later. But for accounting purpose, it will be liability. Okay, is it clear? Equity, if the issuer has an option, equity. Holder has an option, liability at the time of accounting. Later on, if the issuer has an option to issue equity but he pays cash, that is okay. But for the timing, initial recognition will be equity. A contractual obligation would arise only at the point when the issuer exercises its right to redeem. Now come to next paragraph, derivative. Is it there in your notes? Or first we'll solve one small example. X Limited issued, there is a question below, 15 number, with answer also. Wow. Is it there? 15 number? We'll read from the book. It's not appearing on the screen. X Limited issued 1 lakh zero coupon bond. Have you done this? Yes. Only partly. Of rupees 10 lakh. Debenture will be redeemed at the end of third year, issuing 1,45,000 own equity share of rupees 10 each. Now this question, up to this we had discussed earlier. That time my purpose was different, to check whether it is a financial liability or equity. Should the equity settled debenture be classified as equity transaction or a liability linked transaction? This we have answered, it's an equity transaction. Yes or no? Because fixed amount of cash against fixed number of equity share. Now once it is proved it is equity, show the necessary accounting entries. So the accounting entry will be, you are going to receive a cash, how much? 10 lakh. Redemption premium account debit 4 lakh 50,000. And equity settled bond account 14 lakh 50,000. And then you have to pass no entry for next 2 years. And in the last year, equity settled bond account debit to equity share capital account. Nothing will be routed through profit or loss. And that premium account will be adjusted in the equity only. Premium account will be adjusted in the equity only. Paragraph number 18 now. Derivative over own equity. We had a long discussion on this. Once again, a small summary only. Specific rules applied to derivative over own equity. For example, a purchased call option over a fixed number of shares will allow the issuer to buy back shares at a fixed price in the future. The issuer always has a choice as to whether it wishes to pay cash, because it always has a choice as to whether it wishes to exercise the option. So if you have an option to pay cash or share, then in that case the instrument will be a equity, because you can always avoid delivering cash. Okay. But if it is a net settled transaction, do you remember net settled transaction? Derivative, only the difference will be received or paid. If it is a net settled transaction, then it becomes a liability. Okay. Net settled transaction means difference between the contractual amount and the market value is received or paid. So then it becomes a derivative and it will be accounted as an asset or a liability, depending upon whether it is potentially favorable or unfavorable. But if it is gross settled, equity, because you can always avoid payment in cash. So derivative on own equity, if gross settled, equity, net settled, either a liability or an asset. Okay, 30 seconds for this question number 16. Question is, entity Y issues 6% cumulative non-redeemable preference share with discretionary dividend that are subject to availability of distributable reserve. Directors of Y can decide at each period end whether and the extent to which a dividend will be paid on the preference share. The terms of the instrument include a dividend stopper. That is, if no dividend is paid on preference share, then no dividend is paid on Y's ordinary shares. Is the instrument an equity or a financial liability? It's a non-redeemable preference share. Means redemption is not there. So the only thing the investor will get is the dividend. Now whether dividend is discretionary or mandatory? Answer is over. It is a financial? No. It is an equity. मेरे साथ साथ हाँ बोल रहे हो. So the answer, it will be an equity. The payment of dividend on preference share, is entirely at entity wise discretion. For this reason, the issuer continues to have an unconditional right to avoid the outflow of cash or other financial assets and therefore preference shares are equity. Okay, does this sentence matter? The terms of the instrument include a dividend stopper, that is, no dividend is paid on preference share, then no dividend is paid on entity wise ordinary share. This much is enough. Company has a full discretion. Now opposite of dividend stopper is dividend pusher. Let us see what is that. Try this question. First you think 30 seconds. That is enough. Question is same, whether this is a financial liability or equity. Entity M issues non-redeemable preference share bearing 6% discretionary non-cumulative dividend that are subject to availability of distributable reserve. Now here at least the rate is defined, but it is discretionary. Directors of M can decide at each period end whether and the extent to which a dividend will be paid on preference share. The payment of dividend on entity M ordinary share is also discretionary. However, the terms of instrument includes a dividend pusher. If a dividend is paid on ordinary share, then a dividend must be paid on preference share. And dividend on ordinary share is discretionary. Is the instrument is equity or liability? Equity, same reason. Because company can avoid equity dividend forever, and therefore company can avoid the preference dividend also forever. Okay, so write the answer. Because the payment of dividend on its ordinary shares, because the payment of dividend on its ordinary shares is discretionary, comma, entity M continues to have an unconditional right to avoid the outflow of cash or other financial assets, comma, and therefore the preference shares are equity. Okay. Now write one homework for you. This is not printed in the notes. In the notebook, write down which of the following is a financial asset or a financial liability or none of the two. Is it right? So you have to think about this as homework, and then we'll check tomorrow how many of you get how many answers right. So you have to answer financial asset, financial liability, neither financial asset nor financial liability. Okay. So out of the three, one option is correct for each one. Which of the following is a financial asset or a financial liability? Write down. There are some 15 or 18 items. First is PPE. Below that, second, intangible asset. Third, investment property. Fourth, capital WIP, capital work in progress. Fifth, I think investment property is appearing again. Write only once. Creditor, bills payable, bills receivable. One below the other. Investment in equity share, security deposit from customers, loans and advances, preference shares redeemable, advance for supply of goods, advance from customers, warranty provision, provision for tax, deferred revenue, inventory, cash and bank, investment in debentures / bonds, gold, security deposit to landlord. Okay. How many are there? Have you counted? 21. Is it 21? So we'll check tomorrow how many of you get 21 right. So you have to write financial asset, financial liability, none of the two. Okay.